Swayam Prabha. Digital India. Educated India.
Hello and welcome to this fourth lecture of the series, which is about ESG analytics and green finance. My name is Atul Tripathi and I'm an honorary adjunct fellow at National Maritime Foundation. So today we are going to be talking about the use of analytics in green finance, particularly financial modeling, derivatives, ESG indices, the use of green bonds, how blockchain is playing a role in the green bonds. What about AI-related financial risk modeling? And a few more topics about raising the capital, the impact on the markets. That's the focus we're going to be looking at. So welcome all to this series. Now, the first thing first is about the use of ESG as a financial resilience. That's the word, the key word out here is resilience, which you need to look at. And that's where, as per the companies with a strong ESG performance had a 20% lower volatility in stock market prices. That is as per McKinsey and ESG financial planning performance reporting. How is it basically being calculated? If you look at it, they have considered factors like on the environmental side, the climate change, the natural capital, and the pollution, the wastage. On the governance side, they're looking at both the corporate governance as the corporate behavior and governance. And therefore, you have got a parameterized approach in terms of environment when you're looking at whether it is in terms of reduction carbon emissions or the kind of green businesses that companies are following or the policies that they are following. Also in the governance factor, the transparencies regarding the approach that the companies need to take with respect to various filing of the reports of the various agencies or the regulators are there. How will you promote your DEI? What about the fairness of workplace? So that's factors that have taken into consideration generally. And basically, it's about the non-financial dimensions when you look at it. And therefore, ability to withstand and adapt the economic shocks rather in terms of market volatility and the operational risks that are evolved and are evolving continuously. That is where the companies are investing heavily in renewable energies from the environmental factor because A, it is financially viable, and B, it's also in terms of the ESG factors that the companies are now looking at, as I talked about a few minutes ago regarding the use of the analytics to figure out the volatility factors in the market. The governance, if you look at the fraud risk, the compliances, the regulatory factors, the fines that might be imposed, and how do you need to take care of all these factors. Therefore, in the empirically stating, as per the studies by MSCI, it states that the high scoring companies that are scoring high on ESG have taken into certain matrices into account, like more profitable in the long run. There is a less volatility during the crisis, particularly we saw that in case of a coronavirus that went by. 2008, the financial markets crash. There is a better allocation of capital by the investors and the institutional investors as well as individual investors. Why does it actually matter for a person? It matters for the CFOs as well as for the investors because they are no longer seen to have a nice word. They're being better, it's seen as better risk adjustment bets that are taking place. The regulators, asset managers, they're globally aligning all the disclosures with the various factors like your EU SFDR, US SEC, ESG rules, and all these factors are taken into account. And therefore, it's not more about the survivability. It's not a luxury anymore. It's about the systemic risks that are taken into account, whether it is a climate change, social equality, natural disasters. And we've just seen a few days, in fact, a couple of days, yesterday, in fact, the earthquake that took place in Kamchatka and the impact that it's had on the tsunami warnings and the safety and regarding the human lives that was taken by the governments and everybody else. So it's helping the organizations to adapt and anticipate non-financial risks, embedding long-term into terminism into governance and investment decisions, and building credibility with the regulators, lenders, your insurers, the community around it, both the investors as long-term investors, short-term investors, institutional as well as individual investors. So ESG readiness actually helps you to affect your credit ratings, cost of capital borrowing, the shareholder value goes up. So it's a very important factor that is being taken into account now. Having said that, when you are corporate line in the times of world of uncertainty, how do you manage it? Because the compliance will keep you legal, ESG keeps you alive. That is what is the important point, and that is where these two are being combined together as a team, I would say. The firms that are treating ESG as a core strategy, not just compliances, they are outperforming their peers by 40% during systemic shocks. That is as per HBR Harvard Business Review 2020. And if you look at it again, let's go back to the supply chain of the world, the climate shocks and the human rights issues. And we saw that in case of the coronavirus, where the supply chain was completely shocked across the world, and the kind of effort that was put in just to keep the supply chain up and running. Reputation, the greenwashing backlash that we have seen sometimes, and that is affecting your survival strategy in terms of your transparency to sustainability linked KPIs, your operations, the physical and the transitional risks that we are looking at on terms of climate risk, natural disasters, a net zero transmission plan. What is about the adaptive facilities, the governance factors that the companies need to take care of? That is where the areas are becoming very important, because during the coronavirus we saw that in fact the ESG leading firms showed lower share price volatility, faster rebound post-lockdown, and a higher stake value trust was there, both in terms of the customers, the employees, as well as institutional investors, the governments. Everybody was having a larger trust. And therefore, climate-related disasters, whether in terms of Australian wildfire that has happened, has been exposed, and it has shown the vulnerabilities in the firms with poor environmental risk disclosures, the ones that are having increased litigation and insurance costs, where the companies have ignored the points out there as far as the climate governance goes. So another factor that needs to be taken into consideration is risk mitigation through ESG integration, and where you're looking at stability in the unstable world, because most of the companies with strong ESG profiles have 14 to 20% lower cost of equity and debt due to reduced down risk. This is as per MSCI ESG report of 2022. And ESG, it's no longer about doing good, it's about mitigating the risk, and therefore ESG is becoming a risk hedging mechanism, because you're looking at integration of ESG so as to reduce your exposure to systemic shocks in terms of climate disasters, labor strikes, regulatory crackdowns. Firms with the higher ESG scores, they are having a low stock volatility, something we've been discussing. Then the environment risk mitigation, because the climate aligned firms, they avoid your stranded assets and regulatory penalties, such as EU carbon border tax, and also provide a proactive investments in green technology so as to protect the long-term asset values and reduce the insurance costs, because the social risk mitigations is becoming an integral part of the governance factor, because labor supply and supply chain ESG practices, that is preventing your operational bottlenecks, becoming also the consumer and the investor trust preservation, is reducing your reputation-driven financial losses are a very classic examples of social risk mitigations. As far as the governance and compliance is concerned, because again, the requirement by the industry/regulators is very high regarding the compliance. So ESG integration is enforcing transparency, it is enforcing auditability, ensuring that there is a resilience against corruption, fraud, and the compliance failures that might be having. So therefore, you are able to prevent your high-profile collapses. Suddenly, take the case of Wirecard or Enron, because of the corruption issues that happened, and the impact on the financial market is going to be pretty important, because the ESG integration is resulting in a lower spread of the credits. Investors are becoming they're looking at a safer and long-term bets in the ESG leaders. Insurers are factoring the ESG practices into the premium pricing so as to give you a good ESG rating. And then, when we look at the approach, some of the data-based approach, you look at it. So when you look at this World Bank websites, a couple of them are very interesting one. Now look at the case of this website where I've taken the Saudi Arabia as an example. So here they're giving you income classification and geographic region and various indicators, and you can So I've taken the Saudi Arabia, you can take any of the other countries, take the case of, let's say the case of China or Mongolia perhaps, when we look at that, look at the changes that are happening. Also, you can start exploring the various factors or ESG profiles that are there. How does it change with respect to Mongolia? You can clearly see that, what is happening, what is the cooling degree days, something we've talked about, heating degree days, heat indexes, all that factors sometimes we'll be discussing. So this is a very interesting site to look at the profiles with respect to countries. And another point on the similar line is the use of data for your ESG pollution. So again, if you go down to this website, you can play around it, you can see what has happened, when was the year of observation, was the last year of the observation, how it has been spreading around, what has been happening with respect to various conditions, emission and pollutions, your energy security, the climate risk and resilience, the food security, natural capital endowment and other factors. And this is as per environment and pollution. Then similarly on the social factors, the access to services, demography, so fertility and all that factor. Take the case of fertility, life expectancy, population ages, which is 65 and above. Similarly, governance factors on economic environment with respect to the GDP growth or proportion of seats that have been held by the women in the parliament. So one can clearly see a good platform to play around with. A couple of examples around the use of data and analytics around so as to figure out how do you integrate your ESG and as to ensure that the risk mitigation factors that are taken care of. And if you look at one of the case studies, let's look at one of the case studies. The Orsted how they have survived and thrived throughout the ESG-driven reinvention. So the Orsted's market capital actually rose from 10 billion in 2016 to over 45 billion by 2023. And that is basically as per the Bloomberg Green 2023 report. Why? The reason of survivability was in terms of energy mix, where they had 85% fossil fuels going up to the new strategies about 99% of renewable energies coming from Orsted. Carbon emissions, where there was greater than 20 million tons carbon emissions per year, that has come down by 85% reductions in 2006. And then the strategy, they have made a complete focus from energy production to climate neutral growth, and therefore approximately about 300% rise from 16 to about 2021. Now that's important because the company has looked at the transformation it has attracted, from the ESG, first from the institutional investors. They have been able to raise green bonds. They have led global ESG indices. They have the risk exposure to carbon pricing, stranded assets, climate litigation has significantly reduced. It has helped the Orsted to, as a first mover advantage and innovation leader in the offshore wind, and now which is active now in more than 15 countries across the world. So some of the key lessons that we derive when we look at this case study, it's not about the risk management. It's an adjustment. It's about strategic reinvention altogether. The investors are being rewarded because there is an ESG forward firms who are looking at it, and they are using analytics and data at every given step to take the right decision, the right perspective. There's a foresightedness, there is resilience and adaptability. The Orsted pivot has insulated it from the fossil fuel price volatility because it has turned now by use of renewable energies and clean energy that is there. So one of the big takeaways when we look at it is, Orsted didn't survive despite the ESG being the pivot. It actually succeeded. It outgrew the entire game. And that is the ESG takes us to one big bottom line, that ESG is not about adaptation and just following certain rules. It's about survivability now. It takes us to one big bottom line, that ESG is not about adaptation and just following certain rules. It's about survivability now. It's Solutions 2023. Now, if you observe the green bonds, the purpose primarily is to raise funds that are exclusively for environment-friendly projects, such as renewables, green bonds. So World Bank has issued a lot of solar infrastructure, the sustainability-linked loans, SLL, It's about varying based on various ESG performance parameters such as emissions, gender equality. Philips as a company is tied up with the loan rate to carbon targets. Then you have the blue bonds, the finance ocean-related conservation, marine biodiversity, sustainable fisheries. One of the key countries that has adopted is Seychelles, where they're looking at the blue bond for the marine ecosystems, and we'll talk about it a few minutes as we go down the line. So that's about strategic borrowing and the financing in the world, where you're having a lower cost of borrowing for sustainability leaders. There is an increase in the access of impact-oriented capital pools, enhancements in ESG ratings, mechanisms to alignment internal KPIs to external investor expectations. So these are some of the big strategic benefits as far as the ESG financing goes. Why does it actually matter? Because the regulatory risk is rising, as I've been telling you over and over again. The traditional risk models are completely they're not there. They're not up to the mark. They're completely incomplete itself. So the ESG-linked instruments are enabling capital markets to incentivize transitions to support resilience in building projects, whether infrastructure, large-scale projects, or even in terms of the ports, or even in terms of your housing. Then it's about funding the climate adaptation, particularly in emerging economies of the world. So ESG financing, it's not about the ethical investments. It's about de-risking your future. And it's about signaling the resilience to capital markets. If your funding strategy isn't ESG aligned, how will your capital be able to access all the risks that are associated with this thing? And that's where this $4 trillion signal comes into picture, because ESG finance is no longer niche, as I just talked about a few minutes ago. It's about global sustainable bond market itself has crossed a $4 trillion in 2023, which is about quadrupling in 5 years. That's a large number. You're looking at within the 5 years, quadrupled as per the Climate Bonds and Initiative 2024 reports. If you look at this thing, climate bond report, and look at the way that's going up and up again, from the gains to SLBs to social and sustainability. Look at this, if you observe this thing. And therefore, the main sectors that are impact are energy utilities, because there's a grid decarbonization and offshore winding, to water and waste, because there is a recycling of the systems and the water waste treatments are taking place. Oceans and biodiversity is another one, because as I said a few minutes ago, again, blue bonds are being introduced because of marine conservation. And some of the impact areas which is actually coming is from Europe, where the policy led, where the EU taxonomy and ECB support is coming around. Asia Pacific, where there's an infrastructure and clean energy support, particularly China, Japan, India. North America's, if we look at it, is in terms of the corporate SLLs and the transition bonds. But why does this data actually matter? Because it is demonstrating the ESG's irreversible integration into the capital markets. It's talking about the bond investors which are now prioritizing your resilience, climate infrastructure, natural disasters factors taken into consideration, the impact of technology that needs to be there, and how will it be able to prevent a lot of natural disasters that might be there and lead to a loss of human lives. The signals and the pressures because of the issues is also there, because there's an adoption of science-based targets. There's a link to financing to measurable sustainability outcomes. So main thing is that a $4 trillion sustainable bond market is telling you a story of capital realignment. It's towards the companies that are future fit, that are climate ready, that are natural disasters, that are able to predict natural disasters and prevent natural disasters. There's a purpose behind it, and these are completely purpose driven altogether. Now, that also brings me to another point, is the Enel's bond, and it's with the teeth, where when ESG is missing the targets, how do you, it'll get costly, because Enel ESG is no longer a promise. It has to be priced to the capital. And therefore, Enel pioneered the sustainability linked bond model by typing financial penalties to the climate performances. This is as per S&P Global 2020. So what they have done is, bond size is about right now $1.5 billion. The target is to reduce GHG emissions to less than or equal to 125 grams carbon dioxide per kilowatt by December. This was as per December 2021, and the outcome has been achieved, because Enel linked green bond has been growing, has an environmental objective, the yield has been high, and the generation gain has been high, and therefore you see there is a 10% per there's a growth every time you're seeing it 10% PP, and that is where there is a redefinement of sustainable finance, because narratives have started to shift from it to the outcome-based accountability, because there is a signaling in the ESG targets. 1, it has to be measurable. 2, it has to be time-bound. And 3, it has to be financially detectable. Therefore, it is opening a door to similar innovations by various companies like Novartis has done it, PepsiCo has done it. Some of the large Fortune 500 companies have now started to get into this game. And this is where it is having a broader market implication, because SLBs are, they are ideal for sectors where there is a use of proceeds, restrictions are there that aren't very practical in nature, but ESG is transforming this entire goal, which is becoming critical. There's a demonstration of how cost of capital is dependent on ESG performance, not just on credit ratings. It's sending a signal to the market and the board that ESG failure is going to have serious financial implications and penalties out there, and therefore ESG is now being A, data driven, B, enforceable, and C, it's being investor driven and insurance companies driven. So risk pooling models, with respect to insurance and cat bonds for climate resilience is another way of looking at things, because since 2007, cat bonds issuance have exceeded $130 billion, providing governments and insurers with shock absorbers against climate risk. This is as per Swiss Re 2023. And this cat bond approach that is there is a very interesting one, because you have a sponsor and they build up a SVP, and then you have trusted accounts with the counterparty swaps, and finally you have the investors that take into consideration. But why does this risk pooling actually matter? Because the climate shocks, they are systemic and correlated, because traditional models are failing where the losses are too concentrated, and the pooling, diversifying your exposure across geographies, industries, and investors. And therefore, the insurance pool in terms of collaborative structures, such as African Risk Capacity or Caribbean Catastrophe Risk Facility, CCRIF, something we'll be discussing next, they allow multiple countries and insurers to share their climate-related losses so as to have a lower premium and the volatility. And the pool design is enabling your quick payouts for an extremely critical emergency response as a measure of critical emergency responses. So, the governments are issuing bonds that are linked to disaster triggers such as Hurricane Category 5 or cases where investors are able to absorb the payout risk in exchange for the higher yields. One of the classic examples is that of Mexico, which is about $485 million world-backed cat bonds, which is covering earthquakes and hurricanes, and it's supporting your sovereign fiscal resilience so as to avoid your debt traps that might spiral out because of these post-disaster situations, because we really don't know how the situation might emerge post the natural disaster that may be happening. And therefore, your ESG-centric dimensions in terms of pools and cat bonds, which is aligning your capital markets with climate resilience financing, is becoming an important point, because cat bonds are increasingly being linked to your parametric ESG indices such as rainfall, wind speed thresholds, and all the other factors. So, ultimately when we look at it, the risk pooling is actually turning your black swans into gray rhinos, quote unquote, and forcibly and manageably fashion. From the risk insurance pools to sovereign cat bonds, or ESG finances, actually rewriting how the markets are absorbing your climate shocks. And some of the factors, take the case of a hazard or exposures or vulnerability that is being fed into the various models so as to figure out your loss excessive event and where you can absorb, and you can get your aggregated loss models, the interest rate models, and the payoff functions so as to get a function around the various factors. Therefore, you're able to figure out what is happening on the ground. That also brings me to another case study around this thing. CCRIF, climate resilience is meeting a rapid payout economies. So CCRIF stands for Caribbean Catastrophe Risk Insurance Facility. Let me repeat that: Caribbean Catastrophe Risk Insurance Facility, which is the world's first regional parametric insurance pool, which is providing you a quick disbursement covering your hurricanes, earthquakes, excessive rainfall, and they were launched way back in 2007. Now it is owned, operated, and capitalized by member governments with support from multilateral institutions such as World Bank, such as EU. We talked about the triggers that needs to be taken into account last time around. It's about index based, as we talked about. The payout is going to be automatically when the disaster index is crossing a preset threshold. There's a timeout in terms of payment within 14 days of the events versus months of the traditional insurance that we talked. There is actually a risk identification is coming from hazard mapping and risk modeling. Risk reduction, because there is a use of spatial and sectoral planning. Risk mitigation is working, infrastructure refooting, education and creating the culture of prevention altogether. There's financial protection because there's a budget planning, there's a risk transfer, there are financial instruments, such as insurance, contingent credits, catastrophe bonds, budget appropriations, and there's a recovery and redevelopment process because institutional planning, there's a strengthening, recovery planning. All together, this is where if you take the case of Dominica in 2017, CCRIF payout helped restore basic infrastructure within days after the Hurricane Maria had taken place in Dominica. Then take the case of Bahamas in 2019, $11 million were paid through CCRIF after the Hurricane Dorian delivered before and the other aid arrived. So it had helped the people at large, and it had helped the governments to transparently rule-based dispersion mechanisms to avoid any delays or bottlenecks that were there. It helped the social protection mechanisms like emergency health support, food support that was required. So CCRF actually provided climate insurance. It's about the recovery. It's about survivability. The fast finance during crisis actually equals sustained GDP and public trust, which is becoming a strategic tool for national resilience. And it's not just about the financial instruments anymore. And therefore, this is also bringing in a new concept of ESG derivatives, which is your ESG, where it is reshaping your investment mandates, and derivatives are evolving over the profit shields. So more than $12 billion in open interest has emerged in ESG futures market, and which is signaling a shift towards sustainability linked hedging. And therefore you have ESG index futures, which is talking about hedging your exposure to ESG portfolios. One of the examples is Euro STOXX50 ESG futures. Carbon derivatives, where you're pricing your GHG emissions and cap and trade compliances. EU ETS carbon futures is there. Renewable energy certificates, you have hedging against REC pricing volatility for green energy financing. You have the solar, wind, and which is being backed by PPA-linked RECs. And you're trying to integrate your broad-based ESG issues with the aim to select the companies to generate the social and environmental benefits, where you're trying to aim to identify the climate risk and exclude the controversial activities, So that's what is coming around. So your derivatives are actually about adoption and trajectories. You have the ESG futures on volume on exchanges like CME, Mercantile, Eurex, and ICE that have grown 3 times since 2020. And because the institutional investors are now using ESG derivatives primarily for overlaying strategies and sustainable portfolios, your tactical asset allocation with ESG bias, your beta neutral ESG factor exposures, because that is where the transparency is coming into picture, because index-based ESG derivatives are standardized exposures and risk transfers. You have incentivized, you have linked your instruments which is aligning with the financing cost with ESG performance, so lower the interest if you meet the targets. Risk management is being taken care of by enabling hedging or of regulatory and reputational and climate transition risks. Your liquidity enhancement, the facilities with entry and exit in terms of ESG-themed investments without large capital outlay. So these ESG derivatives are no more, as I said, they are no more about niche products. They're critical market tools that are enabling alignment of sustainability commitments by providing dynamic financial management, which is helping the ESG market to grow and becoming an actionable and accountable finance world. That's where it has come down to. And therefore, these ESG derivatives also brought in the ESG indices, as we just talked about. So use of, the the various indices that have been created for using the derivative products around the world, because the ESG indices are more than tools. They are signals of what the future value is holding. It's about aligning them with the just ethical. It's about economic strategy. You have these, MSCI, where it's talking about the MSCI ESG lenders, MSCI climate Paris aligned, because the ratings are based, the climate transition alignment, the S&P Dow, which is talking about S&P 500 ESG index, and S&P Global Clean Index, which is sectoral exclusions with re-weighting by ESG scores. And that is coming all the way from this ESG index, which has been created by GRP for the 176 countries based on certain risk indices. And therefore the sustainable funds for the universe has been growing up by 4 times. That's a large number. You're looking at nearly fourfold, in the one decade itself, from 2011 to 2009, 2011 to 2020, 2020. That's a big number we're looking at, because by 2024, over $2.5 trillion AUM is estimated to be benchmarked to ESG indices. Passive ESG funds are growing by 10x faster than traditional passive funding from 2016 to 2023. There's an increase in the use of central banks because of the sovereign wealth funds that are there, that are being enabled by ESG risk factors, because this is being used by the stakeholders such as asset managers when they're trying to launch a new ESG ETF or mutual funds. You have the pension funds, which are aligning your portfolios to the long-term ESG commitments by the various organizations. Corporates are looking at in terms of measuring the eligibility for ESG, such as, for example, is MSI ESG Leaders Board, that they look at the governments, the regulators, they're tracking ESG because of the fact that it brings them a tracking mechanism that is being there in the national sector regarding the alignment in the investment benchmark. So the choices that you're looking at in terms of index construction is, what are the exclusionary screens, such as fossil fuels, tobacco use, weapons? What are the best in the inclusion, such as top performance by per sector? Then thematic tilt is there when you're constructing everything ESG in portfolio indices, low carbon, women-led firms, whether it's having watershed stewardship. What about the dynamic rebalancing based on the ESG ratings or controversies that have happened? We talked about the green backlash in terms of court cases. One of the big trends that we'll be looking at in coming days is around the prime Paris alignment and the climate transition indices. The second would be around nature positive and biodiversity focused indices, which is gaining a huge traction. ESG indices that are using AI as an alternative data sources. We talked about it a few courses ago regarding this use of satellites and track the emissions around the world. And that also, brings me to another point, that pricing is not of caring. This is how the markets have embedded the ESG risk. They're not about caring, only about care. It's about the market doesn't wait for the regulators to price the ESG risk. It is going to react to the real-time signal that is going to come in terms of the capital flows, the pricing premiums, the reallocation of the trusts, because the ESG factors now are influenced by credit spreads, your equity premiums, the valuation, how it is multiplying, the ESG incidents that are there that have happened. What was the trigger factor? How was it handled? What were the factors how did the prices and the ratings go up or down based on the reactions that are there in the financial markets? The ESG ratings from MSCI to Sustainalytics, they are they're being integrated into the sell side of the models and the insurance underwriting, because you see ESG tier has been created from high to low. Because there's a higher would mean about 8 to 10% of the cost of the capital, versus one of the common observations is ESG exclusion, because they are looking at the disinvestments, high CDS and all that stuff. So that brings me, the post-scandal cases, something that happened, that Volkswagen Dieselgate, or BP Deepwater Horizon that happened in the past, they show that about 20 to 30% of equity market erosion that took place in terms of the valuations. Bond yields spiked by 200 to 300 basis points post the incident for these companies. There were delistings or even exclusions from the ESG indices, and that has actually worsened their capital access. So the ESG rate risk in credit and insurance pricing, where you're looking at primarily around insurers and how they're going to use the ESG risk to adjust their premiums, especially for the climate exposed industries like coal, maritime, logistics. What about the credit rating agencies like S&P and Moody's that are including ESG modifier notches in their reassessments? What about the sovereign bonds that are affected in terms of the climate variable, vulnerable countries which are facing climate adjustment sovereign bond premiums? And therefore, the ESG alpha or the risk avoidance, the debate goes on, does ESG alpha actually give an excess return, or it simply it is reducing your tail risk? That's the debate that's still going on in the market. The evidence is showing primarily it's reducing volatility, it's downsizing your risk factor, improving your Sharpe ratios over the time period, and therefore the market is now treating weak ESG governance as a systemic risk and not only as a niche concern that we have been talking about. So that brings me to another point of how will you rate to your rise? How is ESG scores going to shape the access to the capital altogether? Because in today's capital market, ESG ratings are not about soft matrices. They're hardwired into the lenders, the insurers, the risk factors that needs to be taken, and the credit worthiness that has to be assessed by the investors and the regulators. So the firms with top ESG scores are actually paying about 20 to 30 basis points less on the loans than the bonds. And this is as per Bank of America ESG report 2023. Now that's a very interesting thing, because you see every time there's a AAA rating, your average loan rate is about 3.5%, which has got a high investor demand. And the access speed is also very fast to the access to capital markets. And then you have a BBB, which is talking about average loan rate of about 4.2%, which is moderate in nature, and the access speed is basically normal. And then you have CCC, which is about 5.5% plus, which is low, and then there's a delayed. Now, if you look at the Sustainable Growth Global Fund that has happened in the fund launches, there has been about pretty high growth when you look at it in terms of the 108% growth from 2018 to 21, and look at the way it's been growing over and over again. The CGAR has grown that has resulted basically in ESG ratings, which is reflecting the firm's exposure to environment, to governance, to the social factors that they've taken. This is basically coming from MSCI, Sustainalytics, S&P. These are some of the major ratings agencies which are looking at it. It's basically about forward-looking assessments of material risks, not about adjusting the backward-looking approach, or disclosures. Therefore, the lower risk ESG risk means lower cost of capital, because studies have shown that top-rated ESG firms actually enjoy lower interest rates, as we talked about 20 to 50 basis point less, higher credit ratings, and easier access to market during the volatility cycles, while the inclusions in the ESG indices is actually equal to passive capital flows, because the funds tracking the ESG indices, such as your MSCI or S&P 500 ESG leaders, they automatically invest in high-rated firms. ESG ETF have been priced. They have actually surpassed about $500 billion. Let me just repeat that, $500 billion by, so that's happened in 2023 itself. That's the amount of money we're looking at. The low-rated firms have often been excluded from mandates of sovereign wealth funds, to pension funds, to green investors. Therefore, the lenders and insurers are using ESG for insurance underwriting, because the banks have now integrated ESG into credit pricing models. The insurance firms have started to adjust their premium pricing risks based on environment and social risks that are taken into account. The SLLs, or the sustainability linked loans, they are being tied interest rates to the ESG KPIs or the third party ESG scores. On the negative ratings, this can have a big impact on the capital flight, because as soon as there is a downgrade of ESG ratings that takes place, it leads to widespread being widening in the corporate bonds. Then there's equity sell-off of the ESG-focused funds. There is an increased margin requirements in the derivative markets. So as I said, it's not about capital markets, it's about soft metrics as we call them. They're hardwired into lenders, they're being hardwired into how the insurers are working at and looking at the entire fund factor of this game. That is important because one of the factors that they're being used, that I've been talking over and over again, is the use of data. So data is becoming very, very important because that is where the world of AI is coming into picture. This is where the engine of the AI is. And therefore, only 20% of ESG risks are captured in standard reports. AI will be able to unlock remaining 80%, which have been hidden in the use of unstructured data, that is as per World Economic Forum 2023. And therefore, ESG is actually transforming ESG from backward-looking score to the real-time strategic foresightedness, because it is acting as an accelerator towards the progress, towards the goals, by enabling AI-powered algorithms and recommendations where you're able to identify the largest opportunities, to reducing your time and resources, to streamlining your reporting standards across the board by using ESG report builders, responding proactively. You're able to gain enterprise visibility and ESG performance. You're able to improve your collaboration between the various super supplier specific approaches, because the various techniques that are being used, such as NLP, natural language processor, which is about the use of extraction of governance controversies from earnings and calls and newspapers and CSR reports, which would have taken a long time by individual analysts sitting on the desk and reading through reports and preparing the reports at the end of the day. The computer vision, which is where you're able to detect illegal deforestations, the kind of natural disasters that have taken place, what is the impact, how much of assessment needs to be done. What about the insurers when they're looking at it? How much of premiums that need to be paid out, the use of graph neural networks, which is mapping your ESG risks to propagation of across the supply chains. You have anomaly detection, where the flagging of greenwashing by comparing your various ESG disclosures versus the behavior. So actually it has happened or not. And that is why the key benefits of AI enabled or enhanced risk modeling comes in for ESG coming into picture, because you're able to scale up, handle billions of unstructured data now in unstructured data patterns that are existing, give out early warnings because you are able to detect ESG signals before and after they were priced, bias detection, which is very important because they're able to mitigate or resilience any potentially bias that is resulting in the opaqueness. What about the custom score models that are being specific to materiality? That is where the ESG is becoming an imperative, and AI for ESG is becoming very, very important and imperative rather than just an option. It's becoming the nervous system of the entire game of ESG, because it is able to prevent, it is able to detect, it is able to synthetically figure out what is happening and what's going to be happening next. You are able to build resilience, and you're able to drive your sustainable alpha altogether. That is where another new technology that has started to play around, and the use of blockchain, and how it is going to be becoming a very, very important point for green bonds, because the blockchain enabled radical transparency and is becoming a real-time tracking of the green bond pricing as per IFC and World Bank 2023. So if you look at the approach, you have the certain blockchain features such as smart contract, consensus, cybersecurity, immutability, and decentralization. This is which brings into your blockchains of the world, because every time anything happens, your blocks are being created, and every block that is created all the way is being embedded in the system, and therefore any changes will be immutable, because any changes happening out here will be reflected across the board. And that is how your blockchain attributes are coming, because it's accountable, there's traceability, transparency, there's trust, there's responsiveness. And it is one of the big areas that is impacting is the supply chain. Supply chain of the world is becoming very important. That's where you look at some of the pilots that have happened in the world has been by the institutions such as World Bank, where there's Bond-I, that has been issued as the world's first blockchain bond in Australia in 2018, and AUD costing about 110 million Australian dollars. BBVA and Madrid City have played around using smart contracts to automate green bond cycle in 2022. What about, then HSBC and SGX have played around by deploying blockchain to verify your real-time ESG bond impact reporting. And the European Investment Bank has also has issued $100 million euros of digital green bonds on Ethereum in 2021. The strategic implications are multiple for the investors as well as for the insurers, because for the investor, it is an improvement in a huge, and it's a jump in the confidence level that ESG integrity is being followed. There's a reduction in the greenwashing of the risk. For insurers, there's a lower compliance cost, a higher demand for the ESG aligned investors coming into picture. And for the regulators, most important thing, it's about the transparency and the regulation that has been brought forward by the financial taxonomy. And that's why the blockchain is no more about the cryptocurrencies that we always look at it. It's about restoring your trust in ESG capital markets. It's about digital backbone for credible and high integrity of the green finance that has been started to happen. And that brings me to another point. But what is green bonds itself? Let's try and understand that. So green bonds, they're no more about the niche areas they're looking at. They're about they're just financial tools. They're like market mechanisms. They've been hardwired into the sustainability, into a global economic chain, because green bonds are climate actions by the financial firm, where they're trying to transform the capital markets into carbon neutral climate bonds. So you have some of the examples are India Sovereign Bond, Green Bond 2023, which is about 8,000 crore worth right now in size, where they're funding solar parks, rail electrifications, and you have Apple Incorporation's about $4.7 billion plus, and we're talking about green manufacturing because they are one of the biggest consumers of the products. There's a lot of use of mining of rare earth. Then it's about carbon neutral data centers, which they have been running for over and over and again. EIB is another one. It's about 100 million euros plus, which is talking about green infrastructure across the European Union, because the use of these proceeds are being used in terms of excluding a concrete mixing, to sandstone alone, to hydrogen production. And that is where the pathway is happening in terms of technology specifics to EU taxonomy. And if you look at out here, the GSS bonds captured by the climate bonds, it's been completely growing over a time period. And that brings me to another matter, is the risk return impact is tripling on the lens. If you look at it, there's a risk management because you're able to hedge against regulatory and climate risks. There's a return in the potential in terms of comparative yields. There's a growing liquidity that's impacting your accountability, because the insurer is now able to do some kind of a funding of the projects which are very clearly demarcated. And because the global market momentum has been growing from 2015, which is about $42 billion, with about cumulative total issuance of $42 billion to cumulative market size of $160 billion to 2023, which is about right now total issuance of about $600 billion, with a cumulative market size of about $2.5 trillion we're looking at. In 2023, the green bonds actually made up of about 58% of the entire sustainable bond market. The leading insurers, as we talked about, were the EU and EIB and KfW and the China Development Bank. The sovereigns were there, the France, Germany, India. They've all been doing this thing over a time period, which is resulting in the huge gain in terms of the green bonds market itself. And that brings me to another interesting point about SLL, or about sustainability linked loans, which are driving your accountability, because sustainability linked loans are clearest signal to the cost of money, which is now depending on the cost of emissions, because coming from Bloomberg report, Green Finance Report 2023, because one of the component is the key KPIs. We're looking at quantifiable ESG targets, SPT, or sustainability performance target, which is ambitious, but however threshold is there for the borrower to meet. Your reporting and reviewing is taking place within the external verification, and which is ensuring your accountability. The primary reason being that SLLs are transforming your ESG from building strategies to balancing your balance sheet altogether, which is becoming imperative. And you have linked it to the sustainability performances for financial gain or losses, or as we call it, the pain, that's where, the borrower is being tied up for a certain result. So let's take the case of NL we talked about, GHG emission reduction, which is if you miss the target, you pay a higher interest rate. You have the TESCO, which talks about the food wastage and food management. You meet the targets, you receive higher interest discounts. And take the case of India, JSW Steel, which is very specific to energy consumption. You achieve the KPIs, you get a margin adjusted downgrading taking place. That's where, the borrowers are having the cost of sustainability progress that they're monitoring, to the lenders which are aligning a loan book with the ESG strategy. There's a reduction in the loan term and the credit markets, credit risks, and investors, which is signaling your credible transitioning in finance. When you look at the global trends in the market at this time period, by 2023, global SLLs were approximately $730 billion. There is a rapid growth across the emerging markets, especially in India, in Brazil, in South America. The BRICS are the ones that are focusing a lot in this area. There's a sector adopting, some of them are like, heavy industries, utilities, real estate, mining, shipping, logistics, the ones that are having high carbon emissions, and therefore the challenges are also coming out in terms of greenwashing of the risks, where you have the vague KPIs coming around that may be resulting in your prediction of the credibility. You have sometimes there may be a lack of standardization, which might result in KPI varies across the lenders, and the data factors which needs to be taken into account in terms of the internal ESG measures. Linked to the same thing on the similar lines is another interesting thing about the blue finance we're looking at. What happens out here is very interesting stuff, and we're looking at blue finance in terms of which is protecting about 70% of the Earth's water, because it's important to remember and understand the fact that Earth is covered with 75% plus of Earth is covered by water. So that's a very, very big area, because the blue finance is all about is the one that is being measured in terms of coral reefs, to fish stocks, to to the coastal livelihoods, and you have the economic values, which is coming very important, because it will support about 3 billion people with about $1 trillion needed by 2023 itself. And the biggest threats are coming from overfishing, very, very important. Therefore, we need to protect our marine ecosystems. Pollution, very important, because plastic pollution is becoming a very big to the marine ecosystem itself, and the coral reefs, the fishes, and the other kind of animals that survive not only at the surface but at the very bottom of the ocean floors. The climate change that is happening because of you need to look at the sustainable livelihoods, because blue financing is working with respect to the thematic bonds, the outcome of the based on finance, and the risk mitigation tools that you need to look at, because the private access to capital is essentially yet to make about actually 1% of the current ocean finance we're looking at. The blue economy it's about ecosystem and the natural resource management, where we talk about lack of universal standardization. We talked about lack of data is a big challenge. It's about pollution control, solid waste management, to circular economy, because you need to develop your project pipelines, you need to mobilize your public and private capitals, the strengthening of the policy, the sustainable factors that you need to look at. So this is becoming a big challenge across the world, because if you look at the issuers and the green in this market, so the big ones are the ones that are facing the biggest threats across the world, particularly in terms of the rise of the sea levels. You look at the Seychelles, is about, in 2018 itself, they were able to raise about $15 million because for marine conservation and climate resilient fisheries. Belize is a country, $364 million in 2021. They basically did a debt for nature swap to protect the coral reefs, and the World Bank, IBRD has been doing various kind of initiatives where they're bringing in, the coastal adaptation and marine biodiversity into account. Because the access to the blue bond issuance has exceeded by $4 billion globally. So it's still about less than 0.5% of the green bond market we're looking at. There's a growing adoption across small island nations, developing states, as we call them, in coastal African regions and in the Indian Ocean, the Pacific Ocean, which are actually the ones who are actually going to be facing the biggest risk or biggest challenges in terms of the rise of the ocean levels altogether, because this has been linked to SDG 14, which is about life below water and climate resilience. So how are they basically structured? How are these bonds structured? Because they use the proceeds, they are based on the use of proceeds. It is ring fenced for the marine coastal sustainability projects. There's a reporting requirements. There's an annual impact, which is resulting in your annual impact reporting, the third party validations. Then it's about blending the finance, which is often combining your grants, guarantees, DFIs to de-risk your issuance. Then there are performance matrices that have been taken into consideration, such as your marine biodiversity, fish stock recovery, plastic have been removed, removal of plastics that's been linked to GDP. That's why blue finance matters to the world, because there's about 3 billion people that are going to impact immediately because of this factor which needs to be taken into account. And that also brings me to another point, and that is about the risk pooling. How do we manage the risk pooling is like CCRIF, as we talked about a few minutes ago, has reduced your post-disaster GDP shocks by 1 to 2% as per IMF 2020. Now, if you observe very closely, you have got low frequency to high severity, such as earthquakes, major flooding, and then you have the risk transfer that is taking place, because the market risk transfer products such as risk transfer for asset and indemnity property, or insurance for agriculture insurance, then risk transfer for liquidity and budget management such as parametric insurance or insurance linked products that are there. Because on this side you have got international assistance that is coming play, so this is forming the base, whereas the risk characteristics that are generally taken into account is your contingency financial products or your budgetary reserves and allocations that are there. Some of the examples that have come around is, as we talked about, CCRIF, Caribbean Catastrophe Risk Insurance Facility in Caribbean and Central America, to ARC, African Risk Capacity in sub-Saharan areas, which is looking particularly for the drought, which there's a support for the food security and resilience. Basically, it is working financially because there's a risk in there's a reduction in the moral hazard via the various index-based triggers such as your threshold levels or your drought factors that have been taken into account, use of AI and spatial data and GIS, enablement of creditworthiness for countries with the lack of reserve buffers, particularly in sub-Saharan or African nations, some of the Southeast Asian countries. Then it's about unblocking your blended finance, where the donor contribution is subsidizing your premium and reducing your cost burden, acting as a pre-disaster financial tools, talking about use of avoiding the costly borrowing. It has been blended with ESG and climate finance, because global ESG and climate adaptation funds such as Green Climate Fund, Global Risk Financing, now co-financing the premium for the risk, and UNDP and World Bank are promoting these instruments under Article 9 of the Paris Agreement, which is mandating your finances. So the economic payoff and the risk pooling, and we'll look at it, the IMF has estimated about $1 spent on regional risk pooling yields about $4 plus in terms of avoidance of economic damages through liquidity and planning your certainty. Then your risk pooling is reducing your resilience on post-disaster aid, and directly it is linked to sovereign credit upgrades altogether. And that's what brings me to another interesting point, and that is of the transparency, which is very important in terms of the investments, because the entire game of investments is based on transparency. That's where ESG only is as strong as the data that is playing around, or the underpinning of the data. Because because all the way down the market you look at it, the ESG transparency is about compliance check. It's about strategic signal to the market that you are ready for the market, and you have got a transparency factors to be taken into account. So you have the multiple frameworks such as IISB, I've talked about, CSRD, which is about double materiality, and sector-specific KPIs, which is now becoming mandatory from 2024 onwards. Then we have got the environmental dimension, the social and the governance dimension, where we're looking at in terms of what needs to be done in terms of tracking of the data, in terms of emission or biodiversity impact, because it's enabling your carbon pricing. Social terms in terms of workforce diversity, community relationships, where you're looking at assessment of social licenses. So therefore, you have got the entire investment strategies and styles. We're looking at characteristics of certain data which need to take into account to responsible investment activities. Every time we do this thing, we have to go through the cycle of risk for the, we have to take the risk into account, because if there is a lack of transparency, there will be a mispricing of the ESG risk, which will result in your inaccurate portfolio exposures. There will be a reputational damage where the firms will be overestimating their ESG impact. There will be capital penalties by the investors in terms of ESG premiums or discounts based on the data completeness, lack of data completeness, I would say, and regulatory penalties, particularly in jurisdictions such as European Union, US, Singapore, for misleading claims that might have been taken into account. So the market response to transparency has been very high. The funds with high quality ESG disclosures have attracted about 20 to 30% from the capital markets. This is as per Morningstar. The transparency is driving your benchmarks because there is MSCI benchmark, there is Sustainalytics, there is S&P indices, ESG indices, and therefore enabling your integration of sustainability linked finance altogether. That brings me to the end of this fourth of the lecture in the lecture series of ESG analytics and green finance. That's myself, Atul Tripathi, an honorary adjunct fellow at National Maritime Foundation. Thank you. Swayam Prabha is a very good channel to be associated with, not only as an educator but also as a student. It gives you an opportunity to learn new subjects from industry experts like myself, and also from various professors who are there and experts are there in the field. So this is a new course that I'll be teaching. It talks about ESG, it talks about the analytics around ESG, it talks about the various green financial instruments that are there. We'll talk about risk pooling, we'll discuss about what is the nature of weather indexes, what is the nature of finance that is happening, how is the industry looking at it, what are the legal perspectives, what are the technological perspectives, and also most importantly, what is the analytics perspective that we'll be bringing it out. Swayam Prabha has this government website which is called swayamprabha.gov.in. All you need to do is go down, drill it out, figure out which course is most appropriate for you so that you can find out the best one that is available and which is most applicable for your area of learning. As far as this, the way it is challenged, it is transforming the entire education system, because you see there are a lot of people out there who are spread across the country and they want to get access to good quality education given by professors, experts. This is one of the very good channels to be in.